please, please, please act like you're going to sell your business today, because you might have to sell your business tomorrow.
I would rather purchase a seasoned account base than a brand new account with no payment history.
Do you find that in all cases that sellers were actually fully prepared to enter into due diligence?
No, we haven't had one yet where they've been fully prepared to enter into due diligence. There's always something missing.
You can build a 500 account subscriber base that's going to get a low offer when time to sell if there's a lot of problems under the skin. So do the due diligence now.
It could be our worst customer in the world. There is nobody that I will refer to a buyer looking for seller financing.
You will know more about your business the day that you go to sell it than you have since the day you opened it.
Welcome to our Friday coffee break call. We have this call every Friday at 11 a.m. My goal is to bring together security professionals from all over the country and all over the world to share best practices, to share challenges, to share some really relevant, useful information to help them run their business and prepare for the near future and their long-term future. Whether you jump on this call to share, whether you jump on this call to learn, whether you're not sure why you're on this call and you're just here, know that you're welcome here. Don't feel like you have to chime in, but we welcome you too. And I'm very thankful for those of you that are so generous with sharing insights and information and experiences. Well, I'm excited for the topic of our coffee break call today, which is buying and selling alarm companies, what you need to know, what you need to look out for. And I've got Kelly Bond with us, a partner with Davis Mergers and Acquisitions. And Kelly, if you would, could you just tell everybody a little bit about who you are and what you do?
Sure. I have been in this industry for 28 years. I've spent most of my time either doing acquisitions for a company that was a consolidator, working on lending. I spent a brief 4 years with an access control manufacturer that was one of the best stops I ever made because it helped me learn a lot more about the integration world. And for over 3.5 years, I have been representing sellers and buyers in transactions all over the country. My partner, Steve Rubin, has also been doing this for a very long time, 20 plus years, and he's been in the industry over 40 years. We have done a lot of transactions, but I will tell you, I learned something new on every one without a doubt. I would love to say that they all look the same and we have a roadmap and that's what we follow. That is not the case. They are all different. Some are stressful, some are fun. At the end of the day, the goal is to end up with a happy seller and buyer and successful transactions. But I will tell you, I am learning. I will always be learning because there are so many things that change, and I'm happy to share the stories from the trenches and advise or whatever the need may be.
Awesome. Well, we're so glad to have you here, Kelly. And I know that there's some folks on here that have had some experience on the buy side or the sell side of a transaction, buying or selling an alarm company. First of all, I'd like to call on Clint with Peak Alarm. Clint, I know we've talked about this in the past, and you guys have acquired companies in the past. Can you tell me a little bit about what you looked for when you were purchasing these companies and some of the challenges that you might have experienced through those acquisitions?
First of all, where's the acquisition at? Where's the territory? Is it in our core area? Is it going to be an expansion? Are we going to grow into a new territory? So we're looking at those things. We have to start out by looking at their contracts they have in place. Do they have good contracts in place? Do they have the right terms in there that we need? The indemnification stuff? Do they have everything we need in there? Are they assignable? Can they sell their contracts? Are their contracts free and clear? Are they tied up as leverage somewhere? So we have to look at all that type of stuff. Are we just simply buying RMR, or are we buying RMR plus people and vehicles and assets and that type of stuff? So we look at all that. Traditionally, if it's in our core area, we are simply wanting to buy the contracts, buy the RMR. If it's an expansion, like when we had our expansion into the Montrose, Colorado area, then it's a full-blown purchasing buildings and vehicles and equipment and personnel and contracts. And so that changes it as well. I would say one of the biggest hurdles we've had is when we buy companies, we're buying them to tuck into peak alarm company. We're not interested in the previous owner's name and keeping that name going. And a lot of owners have a lot of value placed on their name, and you have to figure out how to not offend them and to keep the deal alive. Why not paying a fortune for a name that you're going to dispose of?
Yeah, that's a good point. And I think seller expectations going into a transaction is really what we're talking about there, right? Is sometimes sellers have this expectation that, hey, I am Jake Vol Alarm. What is that worth, right? Like that is, that's a big, important name in my space. And I think some of the expectations, though, maybe a lack of expectations on what to expect in due diligence. Do you find that in all cases that sellers were actually fully prepared to enter into due diligence?
No, we haven't had one yet where they've been fully prepared to enter into due diligence. There's always something missing. Contracts with no signatures, contracts that aren't assignable, not having cleaned up their aging. There's always something that they're not ready for that raises its head as we're in the due diligence process and ultimately either slows it down or in some cases it's a big enough hurdle that it kills the deal.
Right before the call, Kelly and I were talking about, she just got off of a very long contract review. They were going through contracts and with a fine tooth comb, and she said it was very long, right? Kelly, can you speak to when you're preparing a seller for a transaction? I think that there's a lot of folks out there that are involved in this space in terms of making introductions. And honestly, myself, I have introduced many sellers to buyers, right? But very rarely have I ever gotten involved in helping that seller with preparing their company for due diligence. Can you speak to how you work with somebody that's either really actively pursuing a sale of their business and they want to sell it quickly, or they're just getting their ducks in a row so that when that time comes, they're ready to do it? Can you speak to a little bit about that, I guess, that pre-transaction prep that you do before they enter into that due diligence phase and why it's so important?
Yeah, absolutely. And Clint's exactly right. I mean, there are things that come up that could come in halfway through the process that no one anticipated. It could kill a deal. It could delay a deal. And it's not uncommon for that to happen. One of the things that we try to do very early on is go through what is, and this is something I'm happy to share too, if anyone would like to have it following this call, kind of a due diligence checklist. And it's the list that I provide to a buyer or a seller, and it goes through every aspect of the business. It's everything from your contract to your employee agreement to liens that are on the business or how taxes are done. I mean, it really kind of encompasses everything. I don't typically work with the companies that are in need of getting everything ready. Usually by the time they come to me, they're mostly ready. But I want to shout out to our friend Kirk McDowell. Kirk is a great resource for companies that are not really ready. They don't even know how to get ready. And think of our industry as a whole. I mean, we are 85% mom and pop type businesses. And with that, you've got people that may have been very good at sales. They may have been a great technician. They started a business, but they don't have an MBA. They've been doing this with the help of a CPA, maybe an attorney, maybe by the seat of their pants. But they've been successful. Okay. But they have used outside help to keep them on a path of success. And one of the things that I will tell you, and I say this on every deal and every time I do a chat anywhere, you will know more about your business the day that you go to sell it than you have since the day you opened it, because you're never tracking things as closely as you probably should be. But doing that on a daily basis, making sure you're looking at financial statements and doing that regularly, that you are keeping track of change orders. I mean, just such a gamut of things that you should be looking at all the time so that you aren't caught, especially if you have to sell. Let's say it's a scenario where you didn't expect to, but you have to sell. You want to be ready. You want to be doing your own contract review. It's imperative, not just for when you want to sell though, because it's going to make you more successful throughout the life of your business.
I always tell dealers, please, please, please act like you're going to sell your business today, because you might have to sell your business tomorrow. Or in some cases, I've been I don't want to get on a sad note here, but I've had several instances where dealers have unexpectedly died and their spouse is left now having to figure out what the heck, not only how to run the business, who needs to get paid, but now, trying to sell that business in many cases, adult children that weren't involved in the business now trying to get involved and sell the business. It's really messy. Thankfully, in those cases, I was able to help them connect with the right folks that got them prepared, and they were able to get a fair shake. But I hear so many times that in those fire sales, somebody doesn't necessarily get a fair deal, right? Like it's somebody's an opportunist and they say, hey, look, like I want to come in and buy these accounts cheap. And I hate to see that happen, right? I think that most of you are building a company to create, maybe even generational wealth, right? And so I want to make sure that you're prepared for that. John Tanner on the call. John, thanks so much for coming on. Glad to have you on here. I know that American Alarm has done some acquisitions. Can you speak to some of the challenges, like the specific pitfalls that you guys have had, aside from, just seller not necessarily having their financials in order? What other challenges have you seen as you've entered into working with the seller?
I think just to start off, the two things I'd kind of reiterate is never too soon to start planning to sell your business, even if the intent is not to. And on that second note, succession planning is so important for businesses. You have to run through the scenarios, because I think when it comes time to selling, sell it. If you're not there, it's just a nightmare for a lot of folks. Some of the things that we go through, we've got a smart sheet that we've developed over the years. It's got 300 lines on it. The categories are preparation, closing, kind of data acquisition, customer cutover, and kind of true up. That's a big part of closing that I think most sellers really just underestimate or undervalue, is the impact of all the preparation on what it means on the true up end of it, right? Because all these, in my experience, deals have some kind of holdback or something along those lines. And it's really understanding what's at stake in the holdback and the value of continuing to be involved in the business for whatever that period is, to make sure that you've minimized that change and you've prepared for it. I think a lot of folks that we've run into over the years, they're literally ready to stop. Like they're done. They want to sell their business and they just want to go on to something else. And those are the roughest true ups that we get, because they just turn the keys over. It's like selling a car. Once you've backed it out of the driveway, I don't know who you are kind of mentality. Yeah. And in these kind of deals, that's a big piece of this, is the back end. And so much of that customer relationship, they're reassuring of their existing customer base that this is going to be good and it's going to be smooth, and they have a voice there to call if they have a concern. That's so powerful for those owners to be involved for whatever that time is.
Yeah, and thank you. That's it's such a great point. I think, unfortunately, So many folks get to this decision at wit's end, right? Like they're just burnt out. Something's happened. Their techs, I mean, they had their tech that had been with them for 30 years, who was running the business basically, decided to quit and move to Florida. Like those things happen. And now they say, oh my gosh, I can't go back and do installs and do sales and do all these things. And like all of a sudden, the timeline has changed. Now, John, you mentioned holdback, and I want Kelly's perspective on this. I have seen deals where companies that are maybe not operating in with a long-term mindset in terms of their reputation have structured deals with holdback in such a way that their hope is to shake out a big percentage of accounts, and for those holdback funds not to make it to the seller. Now, holdback is always, it's pretty typical, right, Kelly? But like, what advice would you give somebody as they're evaluating a deal, what to look out for as it relates specifically to holdback?
So holdback is, like you said, it's put in as a protective measure for a buyer to make sure that the attrition does not exceed what it had been, and the buyer ends up losing more revenue than they expected. It's also put into deals where it's not based on recurring monthly revenue. It's based on performance of a company. That would be more what you would see in a deal where it's an integrator selling. So one of the things that I do, that I ask for on every transaction, is that the attorneys put required reporting into a purchase agreement so that the seller has access to what is happening in that year. And it's typically a year. Most deals, the holdback is for 12 months. And it either is, there are certain ways it can be treated. It may be capped. So let's say it's a 10% holdback for 1 year. It may have a cap on it, meaning that the seller is not exposed for more than 10% of that overall purchase price. If it exceeds that, everybody's even. But a lot of them don't. And there is a chance that the buyer flies through that holdback and the seller ends up owing them money at the end of that term. So a couple of things I would say. Sellers always want the holdback to be as small as possible. The risk with that is that you have to write a check at the end of a year or on the 13th month. There are ways to minimize the risk. And that's, like I was saying, have reporting built in so that the seller is providing a report of what's happening. There may be instances where the seller can get involved or be involved, where collections are. And there are some things that you can do to try to mitigate the risk. But I do caution sellers. I know you want a smaller holdback. However, if you can get a smaller or a holdback that may be a little bit larger than you like, but it's capped, or there's a basket that, let's say the first 5% is forgiven and then it starts on 6%. There are things like that that you can do so that both parties feel protected and both parties have a win, so to speak. But the more that you can be involved or at least get reports so you know what's going on during that time frame, the better. And then also, if you have a deal where the buyer is hiring your employees and they're the same people that have been working on collections and they know your customers, it's a good scenario for both buyer and seller, because you wouldn't expect that there would be too many things changing for the customer during that period. A couple of things that I want to point out that typically are in just about every purchase agreement is that they will not increase the price of the monitoring during the holdback period. To me, that is a no-brainer. You should not make any changes to that customer base during that holdback period. The other thing is that there is clear language in the purchase agreement that says if the cancellation of a customer is due to a service issue with the new owner or that price increase, that it does not go back to the seller. might be a little subjective in some cases, but as long as that language is in an agreement, it does help to protect the seller. And I think it's typical in most transactions. I always ask for it on ones that I'm working with the seller.
Yeah. So, you talk about not making changes in rate during the first 12 months because that can impact holdback, can impact retention, right? I mean, people, You raise my rates, you're a new company. Yeah, I'm going to cancel, right? Like no brainer. What about changing central stations? Because I can tell you, I have seen from time to time some real nightmares for dealers that have moved accounts from one central station to another. All central stations are not created equal. There are some really amazing central stations, and we benefit from that in this industry. But it can get messy post-transaction. Do you find that buyers are willing to agree to like a 12-month, hey, let's not mess around with this until we're out of holdback, or how do you typically handle that?
Just kind of quickly thinking back through transactions that I've done, it's probably about 50-50. There are some buyers that have their own central station and they want those accounts in their central as quickly as they can get them there. There are others that will say, we'll commit to a year, but they'll want to negotiate pricing. They may have economies of scale where they're currently monitoring. So it doesn't make sense for them to pay an extra $1 per account to leave the account somewhere, but they may agree if the buyer's central station would agree to new pricing. The one thing I can say on this is to measure twice and cut once. Go through all of the process. All the data is going to be loaded into the new central station. They've got to make sure that all eyes have been on that and that all of those accounts are sending signals. One of the pieces of due diligence that you'll see on my due diligence list is looking at signal history. A lot of buyers will require that a signal has been sent from every customer in the last 12 months. I've got a couple of buyers that have asked for it in the last 6 months. Now, if it's cellular, it's different. You can get into that panel and make sure that it's working. But if they're still on phone lines, they need some assurance that signals are actually still working. So that's kind of where you start. You want to make sure that signals are being sent so that when that transfer actually happens, that everything is getting moved and it is still sending signals properly. It's great if you don't have to move the central station in the first year, but if it's done properly and the central stations know what they're doing, it can be done with no disruption at all to the customer. But to your point, not all central stations are created alike. So you just have to be really careful.
Sometimes we've seen some really some unique SOPs, right? Like not even necessarily like an SOP so much as it's just a very small central station that they work with. And Betsy at the central station just knows how to handle that account, right? And it's different, right? So I would just say, to Kelly's point, measuring twice, cutting once, making sure that all that data is prepared, that everything is planned for in the transition. Kelly, you mentioned something about whether or not the buyer was going to hire those employees. For a lot of sellers, this is a very big consideration, right? I mean, they have folks that have been on their team for, in some cases, decades, since the very beginning of the company. They, many of them, I think, feel a loyalty to those employees. They want to see things turn out well. In other cases, I think there's some level of fear. I mean, it wouldn't be the first situation where an employee post-transaction decided to say, oh, you know what? I don't like this. I'm going to go after all of those new accounts or all of those old accounts because, and it's always this one, it makes my skin crawl a little bit because every time somebody says that I know the scenario, it was, they just didn't like the service from the new company. And so it was I was their tech. It was my responsibility to service them better. And I'm sorry if there's anybody on the call that feels personally targeted by that scenario? Because I'm sure that there may be some folks in the call that started their company from almost that very same recipe, right? I want to call on Kirk McDowell on this one real quick. So Kirk, prior to a transaction, a seller is wanting to prepare their company for sale. Number one, how do you find they can do that in a way that doesn't draw unwanted attention from, staff? How do you handle that with somebody that's preparing for a sale?
Yeah, thanks, Jake. You got to live your cover when you're doing that, as they used to say in the intelligence community. You got to live your cover. The reality is I'm working with 4 companies right now that'll position to sell probably between 9 to 18 months from now. One of the companies, we're doing a total repaper. 2 of the companies, we're re-signing all of the existing agreements there. We are telling the clients, because I think there's 2 constituencies, right? There's the client and there's also the employees. So we're telling the clients, new insurance requirements, we have to do this. We're telling the employees, it's time for us to get up to speed. I think at the end of the day, your employees may figure that out. So
hold on though. Wait, Kirk. If you work for a company and this sounds familiar to you, it may not be that they're selling out, right? So let's give them, let's just wait and see. I just want to, because there could be some folks in the call thinking, man, that sounds oddly familiar. So go ahead, Kirk. Sorry.
Yeah, absolutely. I mean, the reality is our goal is to make sure that our clients have options, right? And that means they may never sell. They may never call a Kelly bond. But at the end of the day, I want them to make sure they have options. And so we go in and we do a pre-due diligence. We take a look at contracts. We take a look at everything Clint was talking about to make sure that they are prepared at the appropriate time. Because for sure, the buyer is going to be doing their due diligence and the devil is in the details. So what we do is we make sure all the details are in order. So when they go to sell at some point, or maybe refinance the company, maybe bring in some equity. And so that's how we normally do it. But I will tell you that we have gotten to the point where sometimes key employees may figure this out, and then we may pull them aside and do a stay bonus or some sort of bonus for them to stay during that process.
So talking about stay bonuses, I think that for a lot of companies, there is some concern post-transaction that there could be some poaching of customers. Now, I'm not an attorney, and I encourage you to consult one, right? Before, nothing that I give you is legal advice, right? But I've heard of scenarios where employees that are not currently under any type of non-compete, non-solicit. And I know there's all kinds of questions right now about non-competes, but non-solicits are pretty much unquestionable, right? Like a non-solicit agreement is, which is an agreement not to solicit subscribers of a company. That's not the same as a non-compete, which is not to compete with a company. There has to be some consideration, right? There has to be consideration for somebody to sign an agreement such as that, right? But generally, it's found that if somebody is given something like a bonus and at the same time an agreement, and the understanding is they get this bonus, they also sign this agreement, they're basically not going to compete or solicit the subscribers. Kirk, can you speak to that as a process? Is there anything you might recommend somebody do other than when somebody started 20 years ago, 10 years ago, having them sign appropriate paperwork to start with? How do they clean up that scenario before something like this happens?
It's tough. It really is tough. And you got to do it day one, right? Doing it day 752 is problematic, right? So do it day one. We are not attorneys, so they really need to contact their attorney. And Kelly and I were involved in a situation recently where we asked 2 attorneys the same question, and we got totally conflicting answers. So the reality is you really do have to do this earlier than later. Now,
I just want to point out that for $450 or $500 an hour times 2, you could have let them go back and forth on the subject until you've arrived at an answer you felt comfortable with.
Well, the reality is I tend to agree with you. I think non-solicitation is out. Non-compete is out. But non-solicitation, Listen, we're going back right now with 2 of the clients and getting non-solicitation with all the employees. And we're doing that as a matter of just key appropriate bit running the business.
Yeah.
So, and a lot of times what the business owner will do is Kirk is the bad guy, right? They'll use me to come in and deliver the message rather than them delivering the message. And so I
give
come
us
in
your
there
best villain face, Kirk. I don't know.
that's
You
right.
just look too delightful for you to be the bad guy.
No, I can be the bad guy, and it gets rid of them being the bad guy. But we're doing that right now.
Awesome.
I want to comment on something else that you said that was kind of different from what we were just talking about on these employment agreements. And I 100% agree. Get them now. If you don't already have them, get them in place. And they should also include benefits plans and things like that. But what I want to speak to is something a little bit different. In some cases, companies that are going through due diligence have key people on staff that they need to assist them through the process. I've got a deal that I'm working on right now where this came into play. There are 2 owners and a CFO, and then there's somebody else on their staff that felt like something was amiss and started talking about to other people that they thought the company might be up for sale. So it was decided that that person, unfortunately, but anyway, that person and the CFO, who was very much needed for the financial due diligence, would be provided a bonus. It was a stay bonus. It is a stay bonus. It's happening now.
But it's a shut up and stay bonus, huh?
It's exactly right. That's exactly what it is. But they also had to sign a non-disclosure agreement. And it was very clear. If you talk about this, not only will you not get this bonus, but your job is at risk, period. So those things happen a lot.
Those carrot and stick, right, Kelly?
That's exactly right. But they're necessary, and they also they can make people feel good about the process because now they've been included. So also keep in mind, talking about employees again, not everyone is going to get hired. And that is just a part of the process. A lot of owners will say, well, I won't do a deal unless they'll take all of my employees. It is very likely, especially if you're selling to a large company, that they don't need all of your back office people. I'm sorry to say that. It's not that they're not imperative to the business today, but they are first going to want your technicians, and then they're going to want your salespeople. And there is a chance. I mean, you've got to be realistic as a seller that they may not need all of those other people. So I just want to encourage you to keep it in mind if you're thinking about it.
I also think that number one, if you've employed somebody, and you want to help them in this transition, making sure that, maybe that is somebody that you feel is going to be redundant post-transaction. That might be somebody afterwards that you want to work with in advance, give them a heads up or some kind of severance so that they're not totally out. I don't know. Maybe that's just me talking. Maybe I'm being too nice about it, but I think it is something to consider, but be realistic, right? Especially if it's somebody like what we've seen in like an administratively, like a controller or administrative, where they're just not going to need that person, or it might become redundant. It is just the reality of it.
You said something about letting people know early on. I will tell you that is very taboo in our book. We highly discourage sellers from telling employees, and I know this feels heartless, but until the closing, things can happen at the 11th hour. They do. I've seen it. I've experienced it, where deals don't close. And now you've got employees that are nervous that they're going to lose their job.
Just work a severance out. Come on, we'll give them something, Kelly. Don't tell them, wait till closing. Give them a nice little severance on the way out. Lawrence Rents from APS. Rents, I know you've grown your company through acquisition. Tell me about a success story with that, because we've talked about some scary stuff. We've talked about firing tenured employees and leaving them out in the street. Let's talk about a success story. Rents, give me one of them, would you?
They've all been pretty recent, so we're still in the thick of things. But when we look at a deal, it's, are we buying the recurring revenue, as someone mentioned earlier, and it's not coming with a customer base? Is it taking a competitor kind of out of the field, meaning they're in a neighboring town, and if I don't buy them, maybe someone else will? We talked about this last week on the call. We take a lot of pride in our brand, and I find the most joy in swapping out the art signs, stickers, and then just the compounding effect that has on our phone ring. Other great stories are when we buy a customer and we find out that we're offering a service there already. We recently, this past week, sold $50,000 of cameras and access control to a client that we were doing their cameras and access, but we weren't doing the alarm. And through an acquisition, we're now their alarm provider. We haven't had a ton of luck with acquisitions yet, with kind of inheriting staff, whether that be a sales team or technicians. But we have gotten some very good clients, and we're in the Northeast, we're in Connecticut and Florida. We're finding more acquisitions in Connecticut. I think it's a little less attractive to do business. And there's a lot of 1 to 2 man companies that they are just selling their recurring, which all these things we're talking about, non-competes, when you're dealing with an owner and you're offering consideration, it's more enforceable, and it's just much cleaner than inheriting an office and employees. It kind of gets rid of a lot of the concerns we've been talking about recently.
I was at, I think it was the Barnes Buchanan conference last year, and one of the active buyers was talking about, their strategy when they're buying companies and actually buying them for the technicians. It almost seems obvious, but I don't think it's looked at when we're looking at, selling some of these companies or buying some of these companies. But there's a shortage of technicians. And if you're in Connecticut and you need technicians, or you're in Florida and you need technicians, some of these buys that bring really good techs to the table are awesome, right? Like, not only from a financial perspective does it make sense, but like, hey, now you've got some really great techs. If you have bought a company and brought on technicians from that company, could you raise your hand for me? All right, Clint, talk to me about that. And do you see that as an advantage when you're buying a company, whether it's in your backyard or in maybe a newer market for you?
Yeah, absolutely. And there's times we pay a little bit more than the value of the company if we know we're going to pick up the technicians and they're solid technicians. But for us, that becomes its own due diligence, right? We're looking at those technicians now. How long have they been with you? What's their qualities? What can they work on? What's their attitude like? What's their attendance like? And we're looking at those employees, because if we're going to pay more for a company than what it's worth because of the technicians we're going to get, we want to make sure we get the value of those technicians for the long haul and that they're not going to bail out day one. And when that's the case, every one we've done where we've wanted technicians to stay on, we've included stay on bonuses for those technicians for a period of time. So we buy in the company, we're saying we're purchasing the company, the assets, contracts, and we want you. And if you stay with us for 12 months, at the end of 12 months, you get this bonus. And typically we'll pay those out 4 times over that year. We'll give them, the first 90 days to get a bonus, and the 180 days to get a bonus, all the way up to the big bonus at the end of the year, because we really want to keep those technicians with us.
I think that's awesome. And the reality of it is that as you're bringing on new subscribers, there is some level of tribal knowledge that I think is, it doesn't make it to the notes on the account. There are some levels of relationship that are intangible, right? That really great, awesome service tech that has a great reputation and rapport with subscribers. Do you find that in those cases, being able to bring some of those folks on helps with customer satisfaction and retention post-transaction?
Oh, absolutely. I mean, if you're buying a company, but your customers continue to work with the same people they've always worked with, they don't see the change and they're comfortable. The same technicians are coming to their place, the same salespeople are going to continue to work with them on their additions and changes. And so, yeah, if you can keep the people in place, it makes for a smoother transition with the customers for sure.
Awesome. And John Tanner, you've seen the same?
Yeah, it's anytime you can get key employees that really add value, especially with regards to their connection to the customer base, is a win for both people involved. We'll say this, for the folks looking to sell their businesses, make sure you don't stay current on the current pay scales, because we love acquiring companies that are way behind on the pay scales. It makes it easy to keep the employees. So just, keep not paying them much. That's great for buyers. But yeah, I mean, anytime we can get key employees that really have a value add, we're excited to welcome them into the family.
I feel like a lot of this call, we've talked about preparing your company for a sale, or considering, how to be, how to handle it prior to the transaction, post-transaction as a seller. I think that there's a lot of folks in the call that are saying, hey, I've reached a point in my business where I am treading water. I am so big, within my market, that just to keep up with my attrition, I have to create new accounts. And maybe for some of you, you've realized, hey, look, like we might have lost more accounts last month than we added. And I think that for a business owner in the alarm business, that's a scary position to be in, because it's like watching your retirement account just go down, right? Like, because that's really what it is. It's your retirement account going down. And I think it's at that point that a lot of companies look at, hey, maybe it's time for me to acquire somebody else, right? Maybe that this organic growth has kind of reached its plateau and, God forbid, starting to decline, right? Maybe we need to grow through acquisition. And for those people, they're probably wondering how much they're going to have to pay. Now, I want to point this out. I get messages all the time from people. Hey, Jake, if you know of any deals, if you know of anybody that's looking to sell accounts, let me know. I'm ready to do it. And I always ask them, well, great, what's your criteria? And they give me the craziest thing. There is no criteria. Deal is the criteria, right? And I ask them, hey, have you done an acquisition before? And most of them haven't. And then oftentimes the next question is, hey, do you think any of these folks would be interested in seller financing? And I got to tell you, there is nobody. It could be our worst customer in the world. It could be a dealer that is just the worst. There is nobody that I will refer to a buyer that has no experience, no criteria, and is looking for seller financing, because I want anybody that's selling their alarm company to get the absolute best possible deal. And it's not going to be through seller financing. Don't get me wrong. I've seen some very heartwarming stories of owners selling their business through seller financing to a key employee. And for them, it was not about getting the highest dollar. For them, it was about transitioning the company to somebody that had been a key part of their story, and they wanted to see that happen. I've also seen those deals fall apart afterwards, and a heartwarming story turns into kind of a sad story and a not a great scenario. Kelly, you represent sellers, and what does that mean to you? What does that mean to a seller, and why is that different?
So first, let me kind of categorize what you might be looking at in the terms of seller financing. There are some very large buyers that might be private equity or a family fund that they like for a seller to keep some skin in the game for a period of time. Not a second bite of the apple type thing, but they might want them to do some, carry a seller note for 3 years. And the seller actually would get financing or, interest paid, and it can be a good deal. Very different from those that say, hey, I want to buy a company, but I don't have any money. So I need the seller to basically give me their company, and I'm going to pay them when I get payments in. not such an attractive buy. And I don't even care if it's your kid that's doing that. And that happens a lot. They rarely go well. They rarely
Take your kid
go
to
well.
the bank. Introduce them to the bank, right?
Well,
Say,
yes.
hey, look,
Yes.
you can borrow money and buy this business, and Thanksgiving dinner will be great, right?
Yes.
We're not going to have
Yes.
awkward conversations on why you're late on making the payment, right?
Right. So if you're a buyer that wants to do an acquisition, I actually had a call with somebody yesterday. We had a great call. They've got a nice business. They probably have some good borrowing power. But you need to go to your bank first, and you need to look at getting a small business loan. Do your homework first and find out how much you can actually borrow. You may then be able to go to a seller and say, hey, I can pay you $500,000. Would you mind carrying $100,000 or something? Sometimes there can also be some tax benefits to a seller who doesn't get all of their money up front. But I would never encourage somebody to go try to buy a business and you have no money. That is just, if you're a seller and you are considering that, I strongly discourage it. There are tons of buyers out there that are willing to pay for your whole business up front. So before you make that decision, do your own homework. But as a buyer, do your legwork first. And if you can't qualify to borrow money, there are wonderful boutique lender, Jim Wooster in our industry. Yeah. Jim is a boutique lender. He does smaller loan amounts. There are great banks that work with our industry, but typically their minimum is going to be about you've got to borrow about $5 million, whether you use it or not. So, but there are options available out there. But to your point, you need to have some skin in the game.
And I would point out.
Can I touch on something there?
Yeah, go ahead, Rance.
I would say, Kelly's, I completely agree. And I've learned most through the due diligence with banks. So we used to bank with Capital Source. They're no longer in the business, but their due diligence requests, they're going to teach you how to run your business and the questions you should be asking when you go to buy a business. So I often have a line. We have an operating line with Webster, and they know my business now. They're a regional player, and that's who we would go to for a larger acquisition. But it's my goal one day to be large enough that whoever is buying me is going to need an industry bank, right? They're not going to be able to write the check out of cash flow. And that's my goal. So although I can make a deal with you right now and write you a check and make due diligence painless because it's coming out of cash flow or an operating line, whoever is buying me is going to ask these questions one day. And I joke, I'm not going to give this business to my kids. My oldest kid is 7, so I have a ton of runway. So I'm going to need to see your contracts, because when I sell 20 years from now, that person is going to ask for that contract. So I've learned I still use the due diligence checklist that I used to get from my bank when I'm looking into companies. And so going through that exercise, you want to be transparent. You don't want to waste people's time that I just want to go through this and then tell you I don't need the money. But Kelly nailed it. People all the time, they call to buy us, and you ask the conversation to these search funds, and it's like, well, where are you getting the money? Because my assets are my contracts, and I don't think you're going to be able to go to your local credit union and just get a loan because I don't have equipment.
Yeah, no doubt. No, thank you, Rance, for that. And I will tell you, going through the underwriting process with a bank will help you learn so much about your business, about your financial situation, about what you need to look for. If you don't have an operating line of credit today with your bank, I would encourage you to go talk to your banker. I have a dealer that, he went to his regional bank, and they have a $5 million advisory line of credit, not a industry bank, but they're a sizable company that was able to do that with their regional bank. And having those conversations early will ensure that you will be prepared to do a deal when a deal comes up. And I think, as the saying goes, time kills deals, right? Kelly, I think most of the folks are hanging out on the call right now, leading up to the very end of it, saying, well, hey, how much are these deals worth, right? And so I wanted to save that to the end. Can you give us an idea on, what it's looking like right now over the past year, near term? What can we expect in terms of valuations on RMR-based businesses? And maybe if you can add a little bit of additional color on how having a project-based business with strong EBITDA, might impact valuation.
Sure. So the good thing about our industry is that we do not suffer a lot of change based on the economy. Multiples on RMR, and some of my my friendly competitors may disagree with this, but I'm telling it from experience. Residential accounts sell for us just as quickly as commercial accounts do. And the multiples have absolutely held. And in some cases, geographically, they've been very high. So I will tell you this, don't be afraid if most of your accounts are residential, because there is still absolutely value in the marketplace. And there's opportunities of where you can go with those. Multiples in general on the majority of the transactions that happen in our space are going to be between 32 and 38 times the RMR. As you've mentioned, there are a ton of factors that have an impact on that. How well is a business run? What does the attrition look like? How are the contracts? Where is the company located? But that is still where the majority of deals fall.
Are we talking about net RMR or gross RMR? And how is that calculated?
So if you are billing out $100 a month, okay, $100 a month, that's
God
what you're billing
you.
out.
I'm way to go.
And you are there's a purchase done of 35 times of your RMR. They're giving you an offer based on your $100, okay? So it's 35 times your $100. What typically happens is then there is a holdback. We talked about that before, of 10%. Okay, we're just going to use that as our number. At closing, you are going to get paid based on $90 of your RMR, and then you will be paid out on whatever is remaining at the end of 12 months. Okay, so if you're billing out $100, your offer is going to be based on $100 of recurring monthly revenue.
Now, Kelly, $100 a month is not $100 a month. Am I right? Can you speak to that?
Yes. So there is another factor in there, what are called pass-through fees. It does not include your central station. So if you pay your central station $4 a month, they're not going to deduct that as a pass-through. What they will deduct is if you use alarm.com or Alula or Total Connect or M2M, and you pay $7 a month. So let's break it down. You've got an account that you bill $40 a month. Let's just make it simple math. You pay alarm.com $5 a month for that account. The buyer is going to deduct that $5 and they're going to pay you on $35 of RMR. Is that what you're asking, Jake?
That is, yeah. And I think that's just really important because, and I want to make sure that I emphasize this point. Pass-through deductions are not a reason to not sell additional services to your subscribers, right? Because Correct. Attrition is also a consideration in valuation. And those subscribers that get the most value for what they pay you monthly may be and have proven to be less likely to attrit over time. And so I want to make sure that we're making the distinction here. We're talking about pass-through deductions so that we understand $40 a month with one account is not the same as $40 with another account. We don't have time to get into how maintenance agreements factor into all of that, but I will point out that you should track your cost of serving customers based on all that maintenance that you do for free, because a seasoned buyer will look at that. They will look at how much free service subscribers are getting, and that will get factored into the price. Callie, one other question on this. We have RMR, and then we have companies. Michael Barnes referred to some of these companies as darling companies at the Barnes Buchanan conference. Companies that not only have stable recurring cash flows through recurring monthly revenue, but they also have some really great project business that they do that's very profitable. Do you typically see a blend of valuations? Like, are they valuing RMR and then valuing a multiple of EBITDA separate from that? How are you seeing that kind of factor into deals?
So to answer your question, I'm going to say no is the answer. Is it a blend? Because typically the RMR is already included in the EBITDA calculation. It's already a part of the revenue that we're looking at in financials. So what we do is if we have one of these darling companies, and we love integrators that have RMR, contractual RMR, by the way, let me just be clear. All that RMR needs to be under a contract, including cloud-based video, cloud-based access control. Anyway, the EBITDA, the revenue companies, and by the way, if EBITDA is not a common acronym, it's your earnings before interest, taxes, depreciation, and amortization. What it gives is a snapshot of how profitable a company is based on the projects they're doing, based on their revenue, and it's taking out the things that may not exist for a new owner. So it's not an exact science, but it is what we use to calculate the value of an integration company. So the multiples of those companies are typically, and again, there are some variables to this. We have some buyers in the industry that are kind of throwing these numbers, out of the water, which is great, but it should be known they are buying very profitable companies. They are typically large companies. Just because you hear that somebody got 10 times their EBITDA does not mean that that's the norm on what every company is getting. So most of the transactions that we are seeing are falling into a multiple range of 4 to 8 times the adjusted EBITDA. There's a lot that goes into the explanation of that, but that just gives you a general idea of where those multiples are. And I will say that if there is significant RMR in an integration company, that they generally warrant a higher multiple. It's security for the buyer. So they're not just depending on new project work. So they are the darlings. We love those. They sell faster. But again, integrators have not always had the forethought of putting everything under contract. Please, if you're not doing it now, get everything under contract that has any kind of RMR, any service agreement, any maintenance agreement, any managed service. All of those need to be under contract.
Awesome. And I just want to speak to this quickly because it adds a lot of, there's so much confusion around it. When we talk about contracts, I hear folks differentiate between a contract that has a long-term a remaining term on it. Let's say it was a 5-year agreement. There's still 4 years left on it. And a contract could also be a month-to-month contract with an evergreen clause, renewing it month to month. Are buyers, or should buyers, be more concerned about the remaining term on an agreement or historical attrition?
I personally would much rather buy a seasoned account base that has customers that have been there a long time, as long as they're on a month to month. Now, the risk at this is a lot of banks will not fund on month to month contracts. So you do have to be careful with that, but it is 1,000 times better than no contract at all. It's great, even if you've got a 1-year contract with a 1-year auto renewal, that's ideal. Most contracts for monitoring are 3 years with a 1-year renewal. That's what we typically see. But I would rather purchase a seasoned account base than a brand new account with no payment history.
Thank you for making that distinction and clarifying that. And I know we're running a little bit over here, but if you're able to, do you have time to answer a few more questions real quick, Kelly?
Yeah, absolutely.
Okay, great. So Taylor asks, do service contracts sell higher or lower than alarm RMR?
So it's a great question. And the answer is it depends.
And that's all we have, folks.
Sorry, that's it. If you've got a monitoring account, a monitored account that they're paying you $40 a month and you've added another $7 a month to cover their service. If you run a truck one time, you are already underwater because you've not covered, most likely you've not covered that service call. Now, there are some things, some provisions that you can build into a contract, like a trip charge. So if you've got a $50 trip charge, that may offset the, what your cost is. So that may be okay. But I would say, look at what it costs you, the average service, and look in your own company for this, but the average service for a residential customer is once every other year. So take a look at that formula and say, gosh, if I'm only charging an extra $5 a month, does that cover my cost? Now, I will say, what do people pay for this? Buyers want to understand what your margins are on those service agreements. Are you covering your cost? What's included? Are you doing warranty work that the manufacturer may replace equipment, but you want to understand the margins on those. Where is the value? If you're just breaking even, then the multiples on those are usually somewhere between 18 and 22 times. But if you're making money on those and you can prove out that you're making money, there may not be any difference in purchase price at all.
Guys, whether you're selling your business or not, track this today, because you decide to buy your accounts every day, right? Like, you have to decide every day, do I want this account or not? And if you're not tracking your cost of doing business with those subscribers, make sure that if you have a service contract with a subscriber, have a line item that you're billing what you would bill a customer that didn't have the service contract. Have a line item associated with an account on your chart of accounts that associates the discount account for these service contracts. And then you can start to look at, hey, how much are these service contracts costing us in terms of revenue, and how much are we generating from it as well? It's very easy for you, if you're disciplined about how you're tracking it, to get reporting and decide, hey, does it make sense for us to offer $5 a month unlimited warranty battery replacement on systems that have tons of batteries and they're wireless and you're going out there all the time? Make sure that you're tracking that. And I know that John, Tanner, I know that you guys are able to track lifetime value and cost to serve subscribers. You guys are able to do that within your system, correct?
Yeah, we can track all of that. I just wanted to add one final thought. We keep talking and everybody keeps talking about due diligence and what this is. I think that for me, the message is there's a lot of people on this call that have built a business. That doesn't mean you have a business that's going to be attractive to sell. And due diligence will help you align your business in a way that makes it more profitable and more attractive to sell. It's not the same to say I built a subscriber base of 500 customers and also, therefore, it is an attractive business to sell. They are distinctly separate. You can build a 500 account subscriber base that's going to get a low offer when time to sell if there's a lot of problems under the skin. So do the due diligence now. Take these lessons, reach out to these experts, look at your business, make changes to how you track this stuff so that when and if the time comes, you have an attractive business to sell.
Thank you so much on that, John. And I would add that if you're a business owner and you haven't taken a vacation in years, take a vacation for 2 weeks. Not only do you need it, number one, but it's going to be a real test for your business to see whether or not it falls apart while you're gone, right? Some of preparing for a sale is making sure that your business, your subscribers will even stay with you if you're not there. And if you can't leave for 2 weeks, really think about that. Maybe that means you need to fix your business. Maybe that means you need to sell your business. I don't know. But it definitely means you need to do something. Guys, I'm going to rapid fire these. What about 10-year customers that are month to month? Stone, it really is going to factor, again, stable account base, low attrition, good customer, ideally not on POTS. I would worry about that with an older customer, newer technology. the older the customer is, whether or not they're going to be on something that's, could even be replaced, especially as we're talking about some commercial accounts. Paper versus digital contracts. Callie, safe to say, as long as it's done right, digital and paper are interchangeable at this point?
As long as it's with a secure provider, like a DocuSign or a Right Signature, and it's vaulted so that you can go back and get it later, but it's not just out in the universe for everyone to get a hold of.
Guys, this is a really, thank you for making that distinction too, Kelly. I see people cheap out on their whatever the cheap version of DocuSign is. I mean, come on, I don't know how expensive it is to get DocuSign or a legitimate platform for contracts, but I would make sure that, whatever you have checks all the boxes for compliance. It's not some freeware that's going to be questionable when it comes to a sale. Kelly, everyone else on the call, thank you so much for sharing your expertise and your time with us. I want to remind everybody that we have this call every Friday at 11 a.m. I welcome you to join us. Whether you have something to add, whether you're just curious, whether you have questions, please join us here. For those of you that do business with us, Robert in the comments saying he just got his blessed and branded panels. Thank you so much for doing business with us. We appreciate the opportunity to serve you. For those of you that don't yet do business with us today, I would love to have that conversation with you. If you're proud of your company name, I look at Clint on the call, very proud of the Peak Alarm name, and John Tanner, American Alarm name. These are very great, and everybody else on this call that has worked for years to build a reputation for their company. I personally believe that it should be printed front and center on the products that you install. I'd love to help you do it for free. Again, whether you do business with us or not, you're always welcome on this call. And I hope to see you next Friday at 11 a.m.